Well, last 3 months, March, April, May, you saw declining purchases by China. That's not an accident because during those 3 months they were declining, India was ramping up. And India took back, you know, a boatload, a couple boatloads, plane load actually, of gold from the UK. So I think they're just taking turns and showing professional courtesy to each other. Now, there's another aspect to this I don't want to get too much into. I think China's done buying the public gold because they're getting ready to roll out the more publicly the M trade and the Brics Swift alternative. And these things are all China is signaling to its partners we're ready to go.
China, the biggest official sector buyer of gold, is expected to resume its bullion shopping spree once prices ease from the record highs hit in May. As the fundamental case for the metal remains, industry players said at a conference this week. According to the renowned financial analyst Vince Lanci, China's declining gold purchases in March, April, and May coincided with India ramping up its acquisitions, including a significant purchase from the UK. China recently announced that it is stopping its gold purchases, and Vince says there are several reasons behind this decision. He believes they may still be buying unofficially to maintain a neutral image and avoid being labeled a currency manipulator. Industry officials say that demand for gold in Asia is surging despite prices hovering near the record highs it hit in May, as buyers snap up the metal to hedge against geopolitical and economic uncertainty. Spot gold is trading a little over $2,300 per ounce, up about 12% year-to-date and only about 6% shy of the record high it hit last month. Considering his analysis, Vince states that China's decision is influenced by its role in Brics. For the past 18 months, China has been the major gold buyer, while India has focused on silver, demonstrating a cooperative approach among Brics nations to avoid competition. He predicts China's recent halt in gold purchases has lowered prices, benefiting other Brics countries like India and Turkey. The Reserve Bank of India has followed the lead of China and other Eastern central banks and ramped up its accumulation of gold. According to the latest data from the RBI, the Indian Central Bank increased its gold reserves by 24 tons through the first 4 months of the year. The RBI added 16 tons of gold to its holdings through 2023. Now we present the clips of Vince Lanci's insights from his recent interview with Silver Bullion TV. Before we continue to delve into this discussion, please subscribe to our channel and activate the bell icon for timely updates.
All right, China stopped buying now for several reasons. Like their announcement to stop buying was for several reasons. Now, this is my opinion. You can say that I might not be right, but I'm right. It's one of several things, and if I don't know, I'm going to tell you I don't know. Right? Look, China doesn't want to be. There's 7 or 8 reasons for China to stop, and the best one is Brics related. First of all, China announced they were done buying because, hey, they probably are done buying officially through the PBOC. They're not done buying, right? That's first. Second, in no particular order. Second, China's coming out on the international stage and they don't want to be labeled a currency manipulator. They make a public announcement, a very public announcement. They play nice in the international community. And at the same time, Russia starts talking about M trade. So they're just making sure that they've remained neutral. They have it both ways. They're not stupid businessmen. I appreciate that. Other reasons, this is where it comes in with the Brics. This is where it gets a little bit more spicy, but I believe it to be true. If you look at the buying that China's been doing for 18 straight months, when they were buying gold, India was buying mostly silver. When they were buying gold, there weren't a lot of other buyers of gold at that level. So, China's the big dog or the big player at the table in the Brics. So when China's buying, if you're all friends, you don't compete with each other. That's how a cooperative works. China gets done buying, gold drops $80, $90, you know, and that makes it cheaper again because all the front runners, all the people that are buying in anticipation of China buying, they get the rug pulled out from them and they get out of the market, and that makes the price more reasonable for countries like India and Turkey. Now, my proof of that, some of my evidence of that is the last 2 months, well, last 3 months, March, April, May, you saw declining purchases by China. That's not an accident because during those 3 months they were declining, India was ramping up, and India took back, a boatload, a couple boatloads, plane load actually, of gold from the UK. So I think they're just taking turns and showing professional courtesy to each other. Now, there's another aspect to this I don't want to get too much into, but I think China's done buying the public gold because they're getting ready to roll out the uh, more publicly the M trade and the Brics Swift alternative. And these things are all China is signaling to its partners, we're ready to go.
During the interview, Vince Lanci discussed that financial markets previously facilitated gold arbitrage through the threat of delivery, but geopolitical shifts and supply chain disruptions have changed this, while he emphasized that Brics nations now prioritize local resources, impacting global commodity prices. He predicted that gold prices may become more expensive in markets like China due to restricted arbitrage opportunities. Gold prices rebounded on Monday after the precious metal's biggest daily drop in 3.5 years in the last session, as investors awaited U.S. inflation data and the Federal Reserve's decision on interest rates later this week. Regarding silver, Vince pointed out logistical challenges that widen price differentials. He further suggested that these discrepancies will persist despite ongoing reforms, unless China liberalizes its financial markets. Let's get back to the interview.
In the good old days, I would arbitrage gold during Singapore hours. I would buy gold denominated in yen. I would sell gold denominated in US dollars, and then I would do a dollar yen swap. So I was arbitraging. I was taking the car apart and putting it back together. And the reason that I was able to do that was because, and this is what people, I don't think people understand this, but the reason I was able to do that, even though I was, I wasn't a $1 trillion fund, the reason I was able to do that and make money on a day-to-day basis or week-to-week basis is because the threat of taking delivery was enough. The financial markets took care of the, what's the word I'm looking for? They removed the friction. So I didn't actually have to make delivery. The financial market said, oh, well, if he doesn't do it, we will. And so the markets converged, and I made money because I was faster or quicker or smarter or knew I lost money for different reasons, right? But when supply chains break and the East says, nope, can't have our collateral anymore, can't have our assets anymore. You want our lithium? You want our lithium? Well, we want your batteries. So put your plant here and we'll give you the lithium. You're not shipping the lithium out. We want you to add to our country. So same thing with gold, same thing with silver. So historically, you were able to do a financial arbitrage and not have to deliver the metal. And then the Brics has their problem with the US, with the West, and they say you can't have our collateral anymore. And so the arbitrage, the financial arbitrage that guys like me did, goes away. Poof. There's no more threat of delivery. You can't deliver it. You can't deliver. It's like in Cuba, you can't get your cigars in the U.S., and you can't get Chinese gold out. And China, we won't send our gold there initially. And you can't have guys like me jumping in the middle and arbitraging it. And so the gold price starts to change. Gold goes from being a global commodity, and silver as well, to being a regional commodity. It's more expensive in China than it is in the US. Well, why is that? Well, it's because they want it in China, and guys like me can't go in there and close it. And then it gets bigger and bigger and bigger. It gets to $100 until JP Morgan and a couple other banks literally said, this is too much. And they went to China and they said, guys, we can make that go away if you let us go out and buy some gold and bring it to you. And they cut a deal. And in October of last year, more than one bank started taking metal out of the COMEX and bringing it to China. And so the price went from a $100 differential to $20. When it opens up again, it'll smack down again. So as long as the U.S. says you can take gold out of COMEX or you can find it in a mine and you can put it on a boat and ship it over there, you're going to see if there's enough money in it, people are going to start shipping the gold to the West, to the East, which is exactly what we're talking about. Wealth from the West to the East. Until China gets their demand satiated or the BRICS economies in general collapse, I'm not saying they're going to, the price of gold is going to be higher there. And every time it gets high enough, you're going to see gold come over. Now, bringing it to silver. There are several reasons the silver price is that much bigger in difference. One reason is I don't care how many dollars the spread is from 30, let's say it's 35 to 30, right? Let's use those numbers, right? That's $5. In a percentage basis, that's a lot bigger than gold, right? But the financial world is about percentages. The real world is about putting gold on ships. How much gold can you put on that ship? on 100,000 ounces of gold, you're going to make more money than on 100,000 ounces of silver. These are real things. You can only make, if you have a ship that can only hold 1,000 ounces, space, literally space for 1,000 ounces, are you going to put gold or silver in that? I'm going to put gold in it because for the same amount of ounces, I'm going to have a bigger differential. So as a result, the silver differential gets even bigger because JP Morgan's going, oh, look at that silver differential. Yeah, but we can still make more money in gold. We'll do more gold. We'll do more. And when the gold goes away, they'll start to attack the silver.
Considering gold's historical annual growth rate of 11.2%, an ounce of gold could potentially be worth about $3,441 in 5 years from its 2023 value of $2,024 per ounce. This estimation assumes that gold continues to grow at its average historical rate. How will these global market dynamics influence your investment strategies in precious metals? Drop your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the next video.